you ever wanted to live off of your investments and not work and have your investments pay you enough to live off of? That is exactly what I did over this past year. On this account, I've generated over $56,000 and over 325%. That is more than the household income of South Carolina, $52,000. I'm going to talk about exactly what I did to generate this, both from an investment standpoint, but also the options strategies that I personally use to generate this income. So, if this is your first time here, what's good? My name is Sam, and for those of you who are returning, it's good to freaking see you. Now, for all the Karens out there, I just want to make it abundantly clear this is not legal, tax, or investment advice. Well, let's get into the video. Let's cover quickly the investment strategy, then talk about some of the options. And the option strategies that I basically use three, and I just reuse them, and then profit from them. And then I reuse them, and I profit from them. And then I reuse them, and I profit from them. And that's just how it's been for the past couple years, but basically I think it's been 6-ish months since I've had a losing trade here. Not that that's a indication of what the future might hold or that I wouldn't have a losing trade tomorrow, but it is just the indicative of where things have been going over this past year. Now, with my investments, because this return here, just let's take a look at the last month, and let me refresh this for the Karens who don't think this is the real account. But this is the past month. I've made 20% and $12,600. Now, of that $12,000, $1,661 is coming from options. So the rest of that's coming from the portfolio. I know what's going on with Tesla. I do a lot of research on Tesla. I know exactly where they're going in the future with a high degree of probability. So that I'm comfortable putting my money in. What I effectively do, right? So that doesn't mean you should put your money there. I know what's going on with the company. So that reduces the risk I have because I know what is happening. So what I do is I trade options, I profit, and then I buy shares in Tesla. So then I do it again. Right? I trade options, I profit, and I buy shares in Tesla. And I continue this, right? And this is what I've been doing for 2 years. This is how over the past 2.5 years or so, I've made over 450% on my money. And this past year, I've been able to ramp this up continually, and I buy maybe 1 to 2 shares per month of Tesla. And then this is the reason for this is because when I first started trading options, maybe about 2 years. I mean, I've been testing and learning about options for several years, but started trading them about 2 years ago. I went from maybe $13,000, which I funded the account with, to $21,000 in about 90 days. And I was like, yeah, this is relatively easy, right, to make money. I was like, it can't be accurate. There's just no way possible that I'm just getting into here and I'm taking my account from $13,000 to $21,000 without, I mean, I understand how options work, but I don't have the experience and built up the intuition on these instruments, right? To some degree, because I've been studying them for years and years and years, but on the other, when you actually do something, it's completely different than studying something. So how is that possible? And then over the course of the next 45 days, I went from 21,000 back to 10,000. Right, so I actually lost some money, and then I worked. So I was like, I needed to reevaluate the strategy that I was using, and I was using all 13,000 to trade options. So I went through, and I didn't do much for the next couple months. I was like, I got to figure something out to not allow that to happen again, but where maybe I'm just going to take less risk, so I'm going to reduce the return, so I won't go from 13,000 to 21,000 in less than 90 days. But I'd have a lower probability of risk in terms of losing that. And through that, over the next 6 months or so, I decided to go through and just buy some Tesla and trade with what was left. This way I would be taking money off the table throughout this process. So I've built up a portfolio of 100 shares of Tesla in this account, and then the remainder I use to trade with. And that is effectively how I invest in this account. I have businesses and other things that are outside of this, but in this account specifically, right? So let's take a look at some of these trades here, and then we're going to cover the 3 option strategies that I use. We've got covered calls, we've got a put credit spread, and we've got call credit spread. So we're going to cover those and look at the specific trades that got me to the $1,661 this month. And then we're going to take a look at 2021 and where we're going from here. So this is the trades over the past 30 days roughly. And they lump in here the end of November, right? So we've got November 30th, I purchased 1 share of Tesla at $579.69. And then we've got this, right? This is a put credit spread we just talked about. We're gonna get into the nitty gritty of this in a moment, but let's take a look at what a put credit spread is. We can see here that this is 3 options, right? 3 contracts. We see 440 here, we see 450 here, and we see this other stuff here, and we're like, what in the serious fuck is going on? This is why I don't trade options, because this confirmation he's showing me just doesn't make any fucking sense. Well, let's take a look here. So this is over on Investopedia. Investopedia you can think of as like Wikipedia, but for like money and finance related shit. This is sometimes called a bull put spread. And let's just read what they have here. What is a bull put spread? Well, what do we know about bull? A bull tends to think the market's going to go up, right? So that you think the market's going to go up, and that would be effectively what this position is indicating. A bull put spread is an option strategy that an investor uses when they expect a moderate rise in the price of the underlying asset. So that is effectively what this position is saying. It's saying that we are expecting the price to increase, or at least stay flat, or even come down. I like to open up my positions way below the market or way above the market. So let me show you what this would effectively be in terms of this case here. We're buying this and we're selling this, right? So effectively what this means is your put strategies, right? So we're effectively doing this in terms of this would be the payoffs for these positions, right? Like if you were to make money or lose money, this would be the payoff of these positions. And this over here would be a buy, and this over here would effectively be a sell. And the only thing that we're worried about is this portion right here. And when we do this trade, what we're effectively saying is that the sell, the premium, the money that we collect from selling this is greater than the money we get from buying. And that is how I got $630 from this trade. Now, the next is this portion right here, 1/8/2021, where you're like, well, it says November 30th. Why does this say a date in the future? Because this expires on January 8th. I'll probably honestly close this out this coming week. So today's 12/27/2020, right? So it's a couple days after Christmas. We can see that this position is right here. I've already effectively made $1,147 from this position. And you're like, how is that possible? It's only $600. Well, let's take a look. Well, that was on 11:30 at probably sometime in the morning that this was executed. Okay, so 10:30 a.m. And then we have this position here also at 10:30. This one was for $200. So I sold one contract in this case, and the delta, right, the difference between the buy and the sell on this case here for $200. So we sold it for say 600 and we bought it for 400. That difference is 200. That's how much we got in this case here. Also on 11:30 at 10:30, so this is 1 minute later, we had another execute at $211. So again, we sold it for 600, $411, and we bought it for $400. So we get the delta on there. And this is very simplistic. Like, this is not, we're like not telling you how to do this trade necessarily, or that you should do this very effectively, because you can still lose money on these trades or whatever. But now we can see that all three of these have been opened for the same time, and each one of these I added to that position. So now we have a total of 5 contracts open. And if we come up here to the next day, I opened one more contract and got $200. So we get, see over here, we buy 440 and we sell 450s, and I collect $202. So now if you're paying attention to this, you can see that that's these positions here. I had 3 contracts for $630, so I made, you know, 210 per contract on that one, 200 on this contract, 211 on this one, 210 on this, for a total of $1,243. And these were executed on 11/30, 11/30, 11/30, and 12/1. So they're basically at the very beginning of the month, with an expiration in the first week, roughly, of January. So we've got about 38 days or something like that, roughly, that before these expire, which means that there's more theta or more time decay on these options. And this total position is this is how much I can make, assuming that they don't get expired, or they expire worthless, right? And most options expire worthless. So I could make $1,243. I've effectively already made $1,147. I'll probably close it out, this position, this week, for $1,200. If I can close it out for $1,200 or just over $1,200 this week. So I'll probably, instead of making, as this indicates, $1,661, I'll probably make slightly less than that, unless I decide to hold this position until the 8th of January, which I might potentially do as well. Now, the next position, which I don't use as much, because I know what is happening with Tesla, right? If we expect Tesla to be going up in price, then we're not going to use a position that is bearish, right? So sometimes when I will use this position, this is effectively doing the same exact thing we just talked about with the puts, right? Where we looked at this. This is effectively the same thing we're utilizing for the calls when we do this position. This is again going to be the payoffs, and we're going to buy and sell at the same time. So this is a payoff for call options, right? So this is when you're long, and then we're going to do the same. Whoops, let's redo that one. We're going to do the same exact thing, but we're going to do it when we're short. And again, this case, we want this right here, where I'm coloring in, is how much we collect, and this is how much we pay for the option. And we want the S, the amount that we collect from a premium, to be bigger than the long position, and this is what's effectively giving us our profit here. And that position I don't use super often, but I do utilize it fairly regularly, maybe once a month, I would say, depending on what I see happening with Tesla. So let's read about what Investopedia says is the definition according to them. A bear call spread, or a bear call credit spread, is a type of option strategy used when an options trader expects a decline in the price of the underlying asset. Remember, bear price is going down. So the way I utilize a call or a put credit spread is I'm going way above the market with the calls and way below the market with the puts, and then just collecting the premium on these. I don't think I have any of those positions in this past month to actually show you. And then you can see on December 2nd, I bought another share at 540, 549. Oh, here we go, call credit spread. I've got one right here. This is a call credit spread that I opened on, and it looks like I did 2 of them. Call credit spread. I have 2 contracts, you can see right here, for $88, so I got $44 per contract. I bought 760 and I sold 740. And during this time, Tesla was probably trading in the low 600s or mid 600s, something along those lines. Then if we take a look at this, this is on the 7th, right? I believe the 7th. Yes. Okay. So this position right here is right here, I believe. Here we go. And this was opened the week after I opened up those first 6 contracts. And this, if we take a look, is a weekly contract. So remember how the first contract, the date said January 8th, 2021? Well, this expires on December 11th, and I'm opening it on December 7th. So it's basically just 5 days before it expires worthless. And then I added to this position again for $60. So the total on this position was $148 that I collected. That's the premium that I receive. If they don't get exercised, I basically get to keep this money. And so over that period of time, and then you can see I actually bought another share. Oh wow, I guess I bought 3 shares this month. I bought another share here for $584. I bought another share. And so these call credit spreads, I'm collecting that premium like this, where this portion here for the short side of it is bigger than this side of it, and that's always going to be the case the way you open these positions. You can see here buying something that's further away from the price that's currently in the market, or selling something that's closer. It's basically like, you can think of the price in the market as like beachfront property. Beachfront property costs more or less than something that's not at the beach, right? It costs more to get beachfront property. So anything that's closer to the market price that's currently trading at, if we look at these two, 760 and 740, and we remember the price around the beginning of the month was around we'll call it 650. Which one of those is closer? The one that we sell. So the one that's closer to the beachfront is going to sell for a higher price. And that makes sense because you have a higher probability that Tesla could come up above $740, right? But to go above 760 is more challenging. There's a lower probability of that happening than there is if it costing over 740. So both of those positions were weekly. They both expired, which means that this right here was all profit. Then the following week on 12/14, I think it was a Monday, they were with the expiration on 12/18. I opened 2 contracts for $154. So let's take a look at those here. Remember, I bought another share here. Here we go. We have 12/14, 2 contracts for about $70 something each, right? $74 or something, or $77 each that I collected. And this is weekly. This is another call credit spread. So this is above the market. And I collected that money. And then during the week, and this one's even higher, right? Because the price came up. This is above the market, right? 780 I sold, which is closer, means I get a higher price. This 800 I bought, so it's a lower price. And the difference between those is effectively $154. That's how much I collected. And in order for me to lose money, the price of Tesla would have to go from, like, say, 680 or whatever it was when I opened this to above $780 for me to start losing money. And that's a long way away for Tesla to move in a 5-day period. It's a very low probability of event of happening. Can happen for sure, but doesn't happen very often. Especially when you pay attention to what is going on with the underlying, meaning Tesla. Like, most of the stuff that comes out in the financial media, like I've learned about prior to it coming out in the financial media. So when you have that level of understanding of what is going on, that you see what is happening before the financial media sees what's happening, at least reported to the masses, it's you already have an advantage to understand like how things could or could not potentially play out. So this position, 5 days later, expired worthless. So that means I collected $300 effectively, and I got to keep all of that. Remember, these positions in bold are still open, right? We already went over this position. Now let's get to this one here, $76. So this one here, I opened 2 contracts. This is on the 21st. So what happened on the 21st? Well, Tesla was added to the S&P 500. That's why that last position was also a weekly position. I didn't want it to carry over the weekend because I wasn't sure how the market was going to respond to the addition of Tesla to the S&P 500. So this was the day after they were included in the S&P 500. This is at 10:49 a.m. And I opened 2 contracts for $38 each. This is a put credit spread. So this one's below the market, and this expires on the 31st. And the reason this is not a weekly is because I didn't know what was going to happen. There's a lot of people that entered into Tesla once they found out that Tesla was going to be entering into the S&P 500 index. So I wasn't sure if there was going to be a lot of those people that entered into Tesla that are more short-sighted and wanted to exit, right? Like I'm holding Tesla for 10 plus years. So I don't give a fuck what really happens to the price of Tesla. It doesn't tremendously matter to me. I'm thinking down the road. I know where they're gonna be $1 trillion company. Like I'm not concerned about like what's happening today. I know where they're going in the future. So when I think about who is entering the market today, there could be a lot of short-sighted or myopic viewpoints, and those people are like, oh, hey, I made $50, or hey, I made this, I'm going to sell my shares. So I wasn't sure if that was going to take place in the week of the 21st. Tends to be lower volume trading just because it's the holidays, but I wasn't sure. So I gave myself to the 31st on this trade here. And this one is still open, but let's take a look at this one. So that's this one right here, right? That's the one that expires. The two contracts. Let's see here, where is it? $38 each, right? And so with this trade, I've already actually made $62. So basically, I could close this one out. I'm just going to let this expire worthless this coming weekend. The expiration is $500, basically. So Tesla has to go from where it currently is of $660 and drop by $140, $130 for me to start losing money. And unless like some crazy shit happens, there's a very low probability that would happen with Tesla. So this is more than likely I'm just going to hold till expiration. What's this last one? Well, that's a covered call. And this is just on Wikipedia. A covered call is a financial market transaction in which the seller of options owns the corresponding amount of the underlying instrument, such as shares of a stock or other securities. So if we go back to my portfolio here, we get to see I have 100 shares of Tesla. Each one of these options contracts is based on 100 shares. So there's a leverage standpoint to that. And in order to sell one without having a defined risk, right? If we're buying and we're selling, the most we can lose is the delta between these. Like take, for example, this put credit spread right here between $525 and $515. The most I could lose on that is $1,000, right? Per contract, and minus the premium I collected. So the most that I could lose on this is $1,000. But this, I just sold it short. So what does that mean exactly? Well, let's take a quick look here at and this would be the payoff for that. So if we take a look at a long, right, this would be the payoff if I was long a contract. Now, what happens when I'm short a contract? Remember, I get to collect this premium right here, and then if the price goes up, I start losing money. That's where this payoff comes down. This is the break-even point, right? This break-even point, I start to lose money if Tesla goes up above a certain point. But when we take a look at this, this is $800. This is $140 over the current price, and it expires on 12/31. So let's find that trade right here. So this one was opened on the 24th, the day before Christmas, for 40 bucks. So this is way outside of the money, way above the market, right? So this is just one way to add additional return to one's portfolio with a low probability event, very low probability that this is going to get exercised against me. And if it were basically to lose money on this, Tesla would have to gain $140. And at any point between now and the 31st, if Tesla gained $140, that would be awesome, right? Because I own 100 shares. But if it went above that, then that's effectively where I'd start to lose money. But anytime between now and then, I can sell this and just I can sell this and close this position out anytime between now and then. So we still have 3 positions open, but effectively what the return is going to yield in terms of cash is over $1,600 this month for trading Tesla options. Now, this is exactly what I'm going to continue doing. As I mentioned earlier briefly, it's been about 6 months, I believe, since I've had a losing trade. If you guys like this video, make sure you press that subscribe button if you're on YouTube, or the follow button if you're on Instagram. I'm going to be doing videos like this every single month as I document my journey of going from where I currently am to getting to $1 million a year. I'm just going to continue my journey, sharing exactly what I do with my other businesses, my real estate, with the supplements, all this other stuff that I do to generate income. So if you're interested in getting to $1 million a year and you are interested in making yourself a better person, then make sure you follow along and take a moment and share this video with somebody else if you think it could help them. Peace.